Today, we answer 9 questions about life insurance, cash values, interest rates, money, and dividends.
We chose to answer these questions on the Wealth Talks podcast because these questions and their answers will be helpful to anyone who uses or plans to use cash value life insurance and the infinite banking concept.
The first question is, do I get to choose the interest rate on a policy loan?
What a question to start with, John, because that's a yes and no answer. If you're just taking a policy loan and not practicing infinite banking, then the answer is no. The insurance company picks your interest rate. But if you're practicing the infinite banking concept, there's 2 loans. There's the loan between you and the insurance company, and that rate is fixed by the insurance company or chosen by the insurance company. And then there's the loan between you and where you loan that money in the infinite banking concept. If you loan it to yourself, then you get to pick that. If you loan it to someone else, you probably get to pick that. If you loan it to make an investment, then the investment's going to determine that, most likely. If you loan it to your business, or you get to choose that interest rate. So there's 2 interest rates in the infinite banking concept, one between you and where the money was lent, and one between you and the insurance company. And the insurance company fixes their interest rate.
This means if I have a credit card at 12%, I could take a policy loan, say at 5%. That rate's going to be set by the insurance company. But when I take that money and pay off the credit card, I can choose to pay the 12% I would have paid the credit card company as I pay that loan back. And that would be practicing the infinite banking concept.
And you really should, because that's being an honest banker.
You were used to paying that money anyway, so you might as well pay it back to yourself. And what that's going to do is actually pay off the loan with the insurance company more quickly. So your last set of payments on your side of the loan at 12% is going to be extra money that accumulates in your control.
You can adjust the time factor because the insurance company doesn't care when they get their principal back as long as they get their interest rate. So as an infinite banker practitioner, you can stretch the time factor out on a loan and make the payment comfortable and affordable, and that makes cash flow a lot easier and manageable.
You do. You have flexibility both on the interest rate that you choose to charge on the side of the loan you control, and also on that time factor. Because the nice thing is the insurance company, that loan is an interest-only loan. So that gives you much more flexibility on the time frame.
So to clarify one more time on that question, yes, the insurance company is setting the interest rate that they are charging when they loan you their money.
Another question that's really common, we hear it a lot, is if the dividend is 5% that I'm earning in a policy, and my interest rate for a policy loan is 4%, am I getting to keep, or am I making 1% on that deal?
I think this is a common misconception because you're talking about an interest rate. Couldn't I just subtract? And it sounds like maybe I should be making the difference. But it's a little bit more detailed than that, because the 5% dividend rate is not a 5% growth in your cash value every year. The 5% dividend rate refers to the earnings that the insurance company is making on their investment portfolio. There's still expenses and mortality subtracted for that from that before you see the result showing up in your cash value.
In this question, there's a dividend rate percentage and there's an interest rate percentage. And now we're thinking that we can take these 2 percentages and, subtract them. And now we've come up with another percentage that we can earn. But we're talking about 2 different things here.
They're percentages of 2 different numbers.
Our next question is, how is the dividend rate determined?
The 5% that we were talking about, the 5% dividend earlier, the insurance company declares this rate. And it's usually based on the investment component of the insurance company's portfolio. So what did their investments do this year? Now, the insurance company is going to look at that and they're going to say, well, what if we don't do as well next year? They're going to put some of that in a contingency fund. So they have a reserve because they don't have stockholders like typical companies. These are mutual companies that we're working with. So the policy owners are the owners of the company. And then they're going to look at the rest They're going to look and see how they did on their the expenses of running the company, how they did on their mortality costs. And then they're going to decide how much of that dividend that they can share with the policy owners.
And then they're going to look at the policy owners and see what risk level that policy owner's life has with the rest of the insurance pool. And they're going to divide that 5% up accordingly. So if I've been with the company for 20 years and I've been paying lots of premiums, and Michelle, you've been with the company 1 year and you've just been paying a little bit of premium, you're not going to get as big a share of that 5% as I am, because my money, my premiums have produced more of those profits than your money has.
Let's see, this is episode 476 of the Wealth Talks podcast. But back at episode 89, we did a podcast where you interviewed someone at a life insurance company, and he talked about how dividends are determined. And we chose that particular person, but many of the other companies we were talking to, they had the same information to supply us about dividends. And dividends there's no set rules about how a dividend can be declared. So one company might say, hey, we're giving a 5% dividend. Another company might say, we're giving a 6% dividend. But how that is determined, how that is portrayed is different.
It doesn't mean you're going to see that amount of growth show up in your policy cash value. You might see more cash value growth from the 5% dividend than you do from the company with the 6% dividend. So you can't compare insurance companies just based on the dividend rate. In fact, some insurance companies choose not to publish their dividend rate because they know that there's so many other factors that affect what is actually paid.
Another question that we get is the dividend rate the same as the compounding annual growth rate of the cash value? And I think you just hinted at that, John. But the answer is no. The compound annual growth rate is something that we can look back at and retrospectively calculate. It's not something that we can look forward to. Those are all projections. We can look at the guaranteed values, and we know exactly what the compounding annual growth rate will be because those numbers on the guaranteed illustration, if you pay this premium and you pay the interest due on any policy loans, those numbers are guaranteed to be there. But the dividends are not. And so the dividends are part of the compounding annual growth rate in a policy, but they're not the same thing once they're paid.
Once they're paid. Which leads us right to our next question. What is the interest rate the guaranteed cash values compound at? And the thing about it, guaranteed cash values can be based on a rate behind the scenes, but the rate, it's easier to think in terms of what are the guaranteed values. You can calculate a rate backwards from that based on the premiums that you've paid. But remember, expenses and mortality are involved in each insurance illustration. So guaranteed values may be a little bit different for somebody that's age 30 versus age 35.
Now, there used to be in a lot of contracts a 4% figure that said the guaranteed rates are calculated based on a 4% earning rates of the insurance company.
Yes.
And people thought, oh, I'm earning 4%. No, that said the insurance company's portfolio. Mortality and expenses have to come out of that 4%, and then what is left of that, they can provide the guarantees.
So some people think, well, if they're taking expenses and mortality out of it, what if the expenses and mortality end up being worse? What happens to my guaranteed values? That's why it's not a guaranteed. That's why the 4% part isn't guaranteed. They take that expenses and mortality out ahead of time, and then they guarantee the actual value.
It's very important that when you're looking at a whole life illustration, that you don't go dreaming about what the possibilities are on the dividend side, because those aren't guaranteed, but that you look very carefully at the guaranteed values and to see if those numbers are something that is going to be conducive for you to purchase that policy. Dividends are nice when they're paid. They're not guaranteed to be paid, but once they are paid, they can never be taken away.
That's really nice because in any other type of investment, if you make money, you can often lose it as well. But with life insurance, once that dividend is paid, it becomes part of your new guaranteed values. You're not losing that again.
And I suppose that's part of the reason why whole life insurance is not considered an investment. It's an asset purchase.
So I think a general consensus would be that if you're talking about interest rates in a policy, you're talking about something different than whole life insurance. When we're talking about interest rates in life insurance, we're talking about universal life policies because those are based on an interest rate the policy owner is or isn't going to earn.
We can calculate what is called an internal rate of return based on the guaranteed values or on the projected values at any point in time. And we look at the premiums that have been paid and when they were paid and what the guaranteed or the projected cash value is, whatever we're figuring it on, and we figure what rate of return would have had to been earned on all those premiums to end up with the cash value that we have today. That would be called an internal rate of return. And it is a metric that can be used in some cases. It is more advanced.
So, question number 6. When I repay a policy loan with interest, am I paying myself back?
I think this goes back to question number 1. Do I get to charge the interest rate? So on the side of the loan that you control, between you and whoever you loan the money to, yes, absolutely, you can choose that rate. Sure.
Just like in the credit card example, when the insurance company was charging 5%, but the credit card company had been charging you 12%, you paid off that loan, and now you're going to continue to pay yourself that 12%. Of course, the 5% goes to the insurance company, but after that loan is satisfied with the insurance company, you're getting to keep the rest of that 12% that you were paying.
But who owns the insurance company? The policy owners do when it's a mutual company. So as you're repaying that 5% on the policy loan, yes, it's going to the insurance company. You are one of the thousands of owners of that insurance company along with other policy owners. When you pay interest to the insurance company on a policy loan, that interest goes to improve the profits of the company. It's one of the ways that they make their income. So when the profits are shared with the policy owners, then that is part of the profit of the insurance company. So I think that's where the concept of paying yourself back, because you're a part owner in this insurance company, you're getting some sort of benefit back from that interest. It's not direct by any means, but it can have a filter down effect.
I remember when I first read Becoming Your Own Banker by R. Nelson Nash, I had a CPA read the book because I wanted to see if the numbers made sense to him. And he said, Tom, any time that you own or are partial owner in an entity that's loaning money to you and you're paying interest back that, you're going to win.
I love how specific and useful these questions are. We're going to answer the rest of the questions right after the break.
Policy design is critical to having cash value early in your policy and having it grow quickly. Regular whole life insurance starts out with little to no cash value and a relatively high death benefit. But Nelson Nash, the founder of the infinite banking concept, said, your need for cash during your life is greater than your need for death benefit. That's true. So if you design the policy differently with a paid up additions rider, you can bring that cash value up sooner and cause it to grow better and reduce the death benefit a little bit. This is good because your need for cash during your life is greater than your need for death benefit. Over the years, the cash value and the death benefit are going to grow in a well-designed policy like this until your death benefit is actually higher than it would be in a regular whole life insurance towards the end of your life, which statistically is when you're most likely to need it. That is a win all the way around, and that's the way we write policies here at McPhee Insurance. If you want a well-designed policy that's designed to have cash value early and have its cash value grow quickly, there's two ways you can get it. You can get it from us here at McPhee Insurance. That's the way we write policies. Or if you have an insurance agent you know, like, and trust already, then you can use our resources that we publish on McPheeInsurance.com and on YouTube, McPhee Insurance, to learn how to read a whole life insurance illustration, how a good policy should be designed, and you can use that information along with the agent you know, like, and trust to write a policy that will work for you. And once it is all set up and ready to go and you're ready to purchase the policy, if you want to double check it, you can use our insurance review service and we'll let you know if it's a good policy or not. It's well worth the $75 to have that peace of mind. If you want good life insurance or you want your life insurance reviewed, you can contact us by phone at 660-7000 or by email. Our email is team@mcpheeinsurance.com.
Question number 7. Does interest I owe on a policy loan change every month if I'm repaying it with principal and interest monthly?
The interest rate will not change, but the amount of interest that you end up paying does change. That is adjusted. And it's because of the way the insurance company manages the loan.
The way the insurance company manages a loan is they look and they say, oh, we're 6 months into this loan and there's been principal repaid on this loan. Now we can't charge as much interest, or the interest charge is not going to be as much, even though the rate hasn't changed, because the principal balance is down. And that's the same thing with any loan. If you take a loan from a bank and you're paying principal and interest, the original upfront payments are almost all interest, especially on a home. And as you get toward the end of that loan, then most of the payment is principal, but the rate stayed the same throughout.
When you take a policy loan from an insurance company, let's say the loan is $20,000 and the interest rate is 5%. Well, the insurance company is going to hold 5% for the first year of interest in reserve. So on a $20,000 loan, that would be $21,000 that they hold in reserve. They give you a check for $20,000. The extra $1,000 they either charge as interest in advance or they hold for interest in arrears. It just depends on the way the insurance company is going to handle that throughout the year. But let's say that you pay $10,000 of that loan back halfway through the year, 6 months through the year. Well, now you don't have the interest for the second half of the year on $10,000. That means $250 of interest will be recredited if the insurance company charged that in advance. And based on whenever you repay the principal throughout the year, that interest is adjusted on a daily basis.
Question number 8. When I borrow money from my whole life policy, how does it affect the guaranteed growth of my policy? How does it affect dividends? And how does it affect the face value?
That's a 3-in-1 question right there.
Yes, it is. So the first one, how does it, when I borrow money from my whole life policy, how does it affect the guaranteed growth of my policy?
Plain and simple, it doesn't.
That's a great answer. Not only is it a correct answer, but it's a great answer. Taking a loan from your policy does not affect your guaranteed growth.
In fact, that is the one essential that makes the infinite banking concept work, because we get to leverage our cash value, use it for something else, and have the continued compounding growth that takes place in those guaranteed values.
And the guaranteed values will continue compounding as they were guaranteed to do, as long as we pay the premiums on the policy and the interest on any policy loan.
So the next part of that was, how does a loan affect dividends?
It depends on whether the insurance company is direct recognition or non-direct recognition. Basically, a direct recognition company will group the policies that have policy loans together when they look at what percentage those policies contributed to the company profits. A non-direct recognition company groups all the policies together regardless of whether they have policy loans outstanding or not when it comes to calculating the dividend.
And then some companies offer products that are either direct or non-direct recognition. So it's not just the company itself, but it's certain whole life products.
There's a lot of question about whether you should go with a direct or indirect recognition company, and that's really a moot point. Because what I look at is, if you're in a direct recognition company, then you're subsidizing your own loan. And if you're in a company that is non-direct, then all the policyholders in that book of business are subsidizing anyone that takes a policy loan, because those companies tend to pay a lower dividend.
Now, how does a loan affect the face value of a policy? And that's talking about the death benefit. So if you take a loan from a policy and you die during that time, that loan has to be paid off with the insurance company before the beneficiaries are paid. Now, that doesn't mean anyone any of the beneficiaries have to come up with money out of pocket to go pay off the insurance company. The insurance company just says, oh, look, we need to pay $350,000. Oh, but there's a $10,000 loan. That's satisfied now, and the beneficiaries receive $340,000. A client of ours called us. He called and spoke with me, and he was thinking about borrowing from his life insurance to put a new roof on his house. But then he was concerned that if something happened to him, his wife wouldn't get the full benefit of the policy. We talked about that a little bit. I said, Gerard, if you passed and your wife didn't get that full death benefit, but she had the roof on the house and she didn't have to deal with the roofers and those decisions, she's really getting the same value there.
I was talking to David
Or better
Shannon the
value.
other day, and Shannon was worried that if they took a loan from their policy, they would not have the full benefit of the death benefit. I said, well, if Dave takes a loan from his policy, he's going to spend it on you, right, Shannon? And she kind of chuckled. And I said, so you're getting the benefit of Dave's death benefit before he dies. It doesn't matter. You're not losing anything like a lot of people want to talk about. It's just that you get to use that money in advance of your death.
And question number 9, can an insurance company alter my whole life insurance policy contract if I start flight lessons?
Here we're talking about the 2-year contestable period in a life insurance contract. And that's universal across all 50 states, that if you take a life insurance policy out, the insurance company can contest the answers you gave on your application. So if you said you had no plans to take flight school and you started flight school 30 days after your policy was issued and you die in that cockpit, they're going to go back and say, this guy said he wasn't and then he did. So they're probably just going to reimburse the premiums that were paid on that policy.
Rather than paying out the death benefit, because on the application you said, no, you weren't going to do flight school. You weren't going to be a pilot. If you had divulged that you were going to, they would have approved your application, but have you pay extra for that dangerous activity.
I have several life insurance policies that I bought before I became a pilot, but I had no intention of taking flight lessons or becoming a pilot at the time I purchased those policies. And those policies now are past the 2-year contestability period. So God forbid if I should die as the pilot in a private airplane, that is not going to affect my death benefit.
So after the 2 years, the answer is no. The insurance company can't change that if you decide to start taking flight lessons.
The only reason they could change it after that 2-year period is if I lied about my age. If I said that I was 36 and I was actually 46, then they could adjust it for what age I was, and they would still have to pay the death benefit for that if I died after the 2-year contestable period.
This question around flight lessons also would go with scuba diving and mountain climbing, all kinds of dangerous activities. So if you don't die from those activities within 2 years of when you said no to those, you're fine. Because we can all change our mind about what activities we want to do. But if we do that within 2 years of having that policy issued, the insurance company doesn't have to pay that.
What a nice set of questions. I enjoy these podcasts because I know the information we cover will be immediately useful to the person who asked these questions, but it's also going to help other listeners as well.
It's a pleasure to answer your questions here on Wealth Talks. If you have a question or an idea about a future episode of Wealth Talks, send an email to producer@wealthtalks.com.
Next week, we will do an episode on what we wish we knew about money and finances before we turned age 18. You don't want to miss that episode next week, right here on Wealth Talks.